It's an elevator.
It's a Wonkavator. An elevator can only go up and down, but the Wonkavator can go sideways and slantways and long ways and back ways and square ways and front ways and any other ways that you can think of. It can take you to any room in the whole
Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
The Weekly Trend podcast. Today is Friday, June 24th, 2022. S&P 500 currently sitting at 3887. I'm David Zarling. I'm here with Ian William Wonka McMillan. We have a market that likes to go sideways, slantways, and long ways. Where would you like to start this week?
Yes, sideways. Sideways is a direction. It's my least favorite direction.
Trendlessness, yeah. Right.
Basically, sideways since 10 o'clock on Monday morning.
Right.
I guess we did break higher today, but it was a pretty boring week there for Tuesday, Wednesday, Thursday.
Well, and we've got a little bit of a rally on our hands, and I use the term rally, not as in a sense of like a bottom is in place. I also don't like necessarily using the term bounce because bounce implies things too. We just have to take the data as it comes in. But
There's been some bounces.
Yeah.
Some things that never bounced.
Good point. Can you highlight some of those that you're talking about? There are some things that are moving higher that haven't been in the recent past.
Well, I guess, cannabis did finally kind of bounce today.
Right. That was the last of when we look at things like ARC Innovation and IPOs and all the beaten down areas that had been previous high flyers. And when I say previous, I mean, I'm going back all the way to fourth quarter 2020, first part of 2021. But IPOs, for example, using a ETF like IPO, still down 56% from its highs, but an area that has bounced, has seen demand outpace supply. Maybe it's lack of sellers. I don't know. Recently, again, it doesn't fix anything. You would agree that doesn't fix anything big picture when you look at something like an IPO or an ARC.
No, I mean, still absolute downtrends, still pretty harsh. Relative downtrends. You could say relative rate of trend has been, and you can make an argument there, kind of a more, at least, maybe 2022, but certainly not from the highs. Yeah, IPO. I mean, one of the areas that has filled its gaps, and through its gaps, biotech, another one, right? And these were areas we talked about that never went below their May low. So a lot of those areas we talked about last week showed continued strength this week as leaders. Again, those names that have kind of those areas that had diverged
right
throughout June.
When we said that one of the things that had to happen for this market to turn around was that things had to just stop going down. And so your hard hit areas like ARC and SPAC and IPOs and cannabis, those are the areas that had been. And some of them do have divergence. Yeah, biotech. And some of them do have divergence.
And those are areas, right, that perk people's interest when they hear that. I mean, those are pretty risk on areas. I mean, that cannot be denied. Now, are these taking biotech, for example, when you go look at, okay, what's actually making new highs? Biotech is a leader. If I am a swing trader, what am I looking at? I wouldn't say that they're the most attractive names. I don't see Biogens and Regenerons on there. It's a lot more of the
smaller,
like $5, some company that's got like a phase 2 cancer drug, and someone probably wrote like a Seeking Alpha article on how it was going to be big money. I can say that because I used to buy stocks based on that stuff. So
yeah, well, and there's 50 of those at a time, right?
Yeah, exactly.
Biotech's in there.
Dendrion was going to be, I was 21 years old. That was going to be a real big winner. They were going to solve a lot of health issues. And then I think, pretty sure I went bankrupt 3 years later. So,
hey, it's all about
everyone's got to learn, right? Everyone's got to learn.
Better when you're 21 than when you're 40.
And we filled gaps, right? So, I mean, S&P has filled this gap from last Monday, the 13th. We've got another one there from the 10th, that Friday before the Thursday. That Friday gap down. Monday was the big kind of, I guess you want to call it short-term capitulation. I wouldn't say it feels like a longer-term capitulation, but we did bounce off of it. So
yeah, and it's always a mixed bag when throwing the evidence on the table. Sometimes it's pretty clear, sometimes it's not. And was that a bottom? It depends on your time frame.
Mm-hmm.
Okay, are you a day trader? Well, okay, maybe in the very near term it is. If you're someone with a little longer time horizon, this still falls in the counter trend category. So the primary trend being down, right? We continue to we have not negated any. For example, the prior low in the S&P 500 being approximately 3,900, we still haven't negated that today.
I would also say this, and we know that the bounce in May kind of peaked out after a few days. The bounce in March.
Yeah.
I mean, that was a pretty, you go back and look at those daily candles and kind of the thrusts and the behavior we're getting out of those, constantly closing near the highs of the day, pushing higher, big, good, solid green daily candles. It's just not necessarily the same type of, shall we say, enthusiasm that we've seen this week from, at least not in my opinion.
Right. And there's some internals that Ian's referencing that we'll never reveal, but
well, I mean, even looking at these, I mean, we constantly pop higher and then fade. Yesterday was a little bit better, and yesterday we got a good pop. But, I mean, going back to what you said, some other things we use here, it just...
Well, and what's interesting is, so like you look at the late February, so February 24th was the Russian invasion gap down in equities.
Yes.
And we moved higher all the way through March.
Yeah, good short-term bottom.
Yep. And then failed right at the end of March.
That's when everyone was sharing those charts. Do you remember everyone was sharing the charts about how you should buy the beginning of the war because it's bullish for equities? And they would go and they showed, Korea, Vietnam, all these times. I mean, the things people come up with.
Well, and that's just it. We have to remember that we're dealing in markets, and markets get to do what they want, and they don't adhere to any past rules, and that's the danger, right? Because everybody sets up their risk parity trade, everybody sets up their quant box, and it's all based on the past, and things change, and there could be something that's in phase that is worth being involved in for 40 years, and that can change. But to your point, talking about the Russian invasion, would you have guessed that gold, agriculture, commodities, oil, and natural gas are below the Russian invasion prices? Right? Because those should be higher, right? Because there's war. And I'm being tongue in cheek and a little bit facetious there, but it goes back to you can't
treasuries. All of it.
You can't marry the narrative. And since
World
that
War III,
March,
that's what we were going to have, World War III.
Right. And since that late March move, we had a false breakout there, and stocks are still down 16% from that point, almost 21% when you're looking at the base of this. But we continue to see lower highs, lower lows, downward sloping 200-day moving averages.
Energy has now officially joined the party.
Yeah, correct. Correlations. How many times have we talked about correlations? We're having correlations that continually move to 1.
I was going to say, if we were probably at like 0.9 earlier, I don't know, there's actually a Twitter account there that does some pretty good work on that. And Yeah,
I mean,
it's been pretty high for months now.
Right. And that's what happens when you're in corrective periods. So here we have the S&P on the week. If we close like this, potentially up 5-6% on the week, that means it's over, right? Not necessarily. I mean, I'm always open to the idea that it can be, but all the other data is still in place. Lower lows, lower highs, downward sloping moving averages, correlations moving to 1. And now we're seeing commodities.
I mean, yes, we just talked about energy and crude oil. We're back below 115. We never got above 125. So there's really nothing triggered for us to move to that 150 level. Now sitting at 106. I think we hit like $100 a barrel yesterday or 2 days ago. But broken uptrend or broken rate of trend. If we go back to the December 21 lows, commodities, I mean, base metals, oh my gosh, crushed.
Yeah, base metals. And so can you label some of the base metals that we're talking about here?
Well, you've got tin, nickel. I mean, tin's down another 10% today.
Well, and these are like
50% off its highs.
Yeah. And we could label these industrial metals too, correct?
Yeah, I mean, 22%. Yeah, industrial base. Nickel down now 61% off its highs. Aluminum having another rough day. Aluminum 43% off its highs. All these are breaking big levels too, right? They had the big run-ups in February and March, consolidated, and now seem to be in their own stage 4 declines.
Well, that's just it. And if you don't have a risk management process for this,
nat gas,
you have to manage risk, and how much more so with commodities, right? The beta meaning volatility is that much higher. These things move quickly. So if you don't have a risk management process for energy stocks and commodities, then, I mean, things could hurt really bad. Because we've been involved in commodities in the past. We're not opposed to that, and we will be again when that returns. But for right now, industrial metals, and I think of Dr. Copper that's a big breakdown this week.
Dr. Copper was a signal that a lot of this was not healthy, and all of his little brothers and sisters have now followed suit.
I mean, Dr. Copper losing let's call it the $4 level, kind of a big deal. And we've seen nothing but selling since breaking that level. And that was this now looks like distribution that goes all the way back to February. Again, there's another market mile marker, February of 2021, similar to what we saw with small caps, which got distributed from that point forward. Did we just watch copper get distributed, meaning institutions unloading their exposure to copper, base metals? Could be. What's interesting is what you highlighted before was energy was holding out, doing well. Now we're seeing commodities, which had been doing well, not doing well. So these correlations moving to 1. This is what we see. This is what we see in bear markets. There's no other way to paint it. When you have important areas breaking important levels and you have lower highs and lower lows on your hands, it's the very definition of a downtrend, very definition of a correction. So is it over? I have no idea.
Yeah, I mean, maybe there's a lot. I mean, more mixed signals kind of during this, if we call it an attempt to put in a bottom. I mean, other bottoms, I would say, was a lot clearer. That probably going to roll over and go lower. This one, yeah, I mean, there's more positive things out there.
There is, and it's just interesting that you could see, from the beginning of the year on, we've seen stocks and bonds move down, and commodities had been moving up, and now all 3 are moving down. We'll see. And
I mean, breadth. I mean, it's not like breadth is. I guess we had a couple. Do we have a 90%? Do we have an 80% day this week? I think we did, didn't we?
Yeah, and we have had in the past. We've had 90% up days. I want to say within the last month that were quickly negated by huge downside days. So
Last 80, yeah. So the 21st, Tuesday. So I guess, yeah, we were off Monday. Market was closed. And today's, I mean, we're in 88 right now.
and what's fascinating
Not
is
shabby.
we had a 90%, almost a 90% update back May 27th, but that quickly evaporated. So you've got this sloshing of liquidity moving around. Really, you need to see mathematically, you just need to see important levels reclaimed. And really, like S&P 500, until we're clear of 4180, we're either sideways or down. That's just the reality of the math. Using something like the S&P 500, the Qs, until we're back above 318, and even above 318, we're back into a range. TLT,
there's so much price history to the left.
Yeah,
so and it much only gets worse the further down we go.
Yeah, and like TLT, treasuries, 20 plus year treasuries, potentially putting in a false breakdown, which would be a false breakout on rates, which would be classic, right? Everybody talking about rates, and rates are going higher, inflation's going higher. But wouldn't it be amazing, or I shouldn't say amazing, but classic behavior to see rates move lower from this point forward and stocks and commodities actually show deflationary tendencies? It'd be interesting. You got to be open-minded to all these outcomes.
Yeah, the inflation talk is definitely the topic du jour. I mean, it has been for months now. Commodities and gas prices have only fanned those flames.
For sure.
Now commodities rolling over. So have we seen, quote unquote, I don't know, some people argue now that, the worst is behind us. We'll see.
Yeah.
Not if they stay elevated.
I was going to say, is the worst behind us is if everything is going down in price? I'm not sure.
And then you got a whole different issue on your hands that you definitely don't want to deal with. I'd rather have inflation than...
I mean, I can think of some pretty big market environments that were deflationary and they were not fun. They cost people jobs. So you got to be careful what you wish for. Yes, we want. Exactly. Yes, we don't want like raging inflation, but the opposite scenario of deflation, also something. So, which brings up, the fundamental narrative of the Fed raising rates. Is the market already discounting something in the future, and the Fed will be cutting rates before you even know it? Could be, but we got to see rates. We got to see rates move lower in the actual market before we see the Fed do something similar.
Yeah, and right now rates are still. I mean, they were down this week, but
they're still above their break
level here. Yep. If you look at the 30-year, 3.4, 3.45. I mean, that's where we peaked in 2018. Yeah, you get through there, you're probably definitely going to 4%.
Yeah, and you've got, commodities, these commodities that we talked about cooling off, the areas that related to them, energy, metals, and mining, even internationally, when we look like Latin America, frontier markets, these are areas that are definitely cooling off and are now entering corrective territory, downtrends. That no longer is there alpha to be gained at this point, or at least the price is showing us that alpha is at risk for anything commodity related. Then when we think about seasonality, Ian,
yeah,
the seasonality of a midterm election year, it's typically volatile. I mean, there's no doubt about it. And from the period of late May through late June is typically weak, and we've seen that.
Yeah.
Now I will add that from March to May in a midterm year is typically bullish, which we didn't see. Maybe the beginning of March, but that's about it. So here we are entering what some would call a holiday period, right? We got 4th of July coming up soon. It's the summer.
Yeah, just holiday, lots of vacations going on in general. Kids are out of school.
Yeah, correct. Kids are out of school. Guys and gals are away from the trade desk. So that there's definitely a seasonal period here where in midterm years, the second year of a new Democratic Party president, late June through mid-August is typically bullish.
Yeah, it's really not till August where things start, and August for really all years too.
Right.
Looking at data from Stock Traders Almanac.
Yeah, Jeff Hurst does great work.
Midterm years definitely more of a bearish tendency through basically from mid-August through right before elections.
Yeah. So, and to paint that picture, what's interesting is in these midterm years, March through May, typically bullish. We didn't see that, that's how you should use seasonality, is when it doesn't match the seasonality, you got to pay attention. May through June, bearish, which is what we've seen. Now, this period of late June through mid-August, like you're talking about, Ian, where it's typically bullish, it's going to be interesting to see how this plays out, because mid-August through October could be pretty brutal if we're not matching the bullish. My point being, from this point until mid-August, if prices aren't matching the bullish seasonal tendency, it leads us to believe.
Yeah, we ignored it in March.
Right.
And look where we are.
Exactly. And so it could be that much more worse late summer, heading back to when people get back to the trade desk, kids are getting back in school, and guys and gals are asked to put on positions, take off positions that are massive in size. We're talking billions of dollars. Does that get really weak in late summer? It could. And that's why we pay attention to seasonality. The other thing
and maybe you could say that's what this bounce. I mean, we did bounce, I guess, for a couple of weeks in March.
Correct. Right. That went into March, that March 29th that we talked about, where, it looked like things were back. We're going to go make new all-time highs, and they yanked the rug. And
got back above that 3680, 3700 area and
took it back down. And the one thing that has been a constant is just the volatility level in this current environment. And I know Willie Delwich, which is a great Uber car driving partner of yours, when we look at 2017, which was historically low volatility, it's almost unfair to compare things to 2017. But 2017 only had 8 trading days in which the S&P moved plus or minus 1%. Each month in 2022 has had at least that many, 8 days or more of days in which the S&P 500 plus or minus 1%.
Today will be another one. So
correct. Yep. And so that's information, right? Volatility continues to remain high. This volatility increases at turning points, but volatility also is high when corrections are underway. And so we continue to see ourselves in a correction. We see high correlations among sectors. Now, we could argue that the sector of healthcare, which is, you talked about biotech, which is half a safety or a risk off, but also half a risk on.
Yeah, pharmaceuticals, all that. I don't know when you stop being a biotech drug maker and start becoming a pharmaceutical company. Maybe that's like a market cap, but I bucket them all together.
I'm sure there's dudes that sit at a table and figure that out.
Yeah, I mean, obviously, like Pfizer's different than, XYZ Therapeutics that's got a market cap of $800 million.
Right.
But they all make drugs and medicine.
But here we have healthcare overall using something like XLV, reclaiming important levels near 125. We talked about that level. Below that was, since it's this one of the larger market capped areas of the S&P 500, below 125 was problematic. We're back above that. Was that a false breakdown? Could be. And same, I think we'll get into this in the extended period or portion of the podcast, but there's some things here regarding some big breakdowns that happened this week, as well as some false breakdowns that we need to keep an eye on. But we continue to see correlations remain high among sectors. We talked a lot about equities. What are we seeing out of the credit space, bonds, that type of thing? We talked a little bit about rates. We talked some treasuries, but.
Yeah, I mean, high yield bonds bounced. I mean, I guess the same you could say is, heck, I mean, they're up like 3 or 4% off their lows, which is pretty good. They're 17. They were 7. I mean, there's still 15% off their highs.
What are you using for that?
Like J&K.
J&K, yeah.
TLT. There were a lot of fixed income versus S&P relationships that had broken to new highs last week. So, I mean, government bonds, treasuries, mortgage-backed, munis, all these different types of things. They're showing up on relative highs. And a lot of those have failed. TLT, I don't know. TLT, what do you think? You think it's going to stall here at 113 again?
I have no idea, but I know that would be an area of polarity. TLT representing 20 plus year treasuries.
Big. I mean, you're probably, you don't have much in the way till 101.
Right. So we're reclaiming this 113, 114 area and moving higher into some area like 137, 135 in TLT, which would bring rates way back down. Or this is just a retest of an area of previous demand that's now an area of supply, and we move lower, like you're talking about, Ian, where we're down by 102. That's a 10% move in an instrument like this. Using something like TYX as the 30-year Treasury bond yield. If we're breaking higher and all of a sudden we're up by 4%, are we seeing 4% rates? Maybe. Could. I'm not here to tell the bond market what to do.
Yeah, the bond market has been on this has been a heck of a run. We did overshoot to the downside. If you go back and you look at this channel, right? The channel, we've all seen it, log chart.
The 35-year channel.
35-year,
and to paint that picture,
there's tons of behavioral touches on both sides of the channel. So I would make the argument that we probably overshot that during the COVID panic.
Right. Well, what Ian's referencing is this 35-year trend, almost 40-year trend in rates and in bonds directionally, and we're kind of breaking that rate of trend. But we'll see if that continues. Like Ian said, it took a lot of energy to break that trend. Is that a fair way to summarize that?
Yeah, and we do. It's exactly what I'm saying. We broke. Rates really, really had a blow off bottom, it seems, during the COVID panic. And we need to have that, does a pendulum swing equally in the next direction before the dust starts to settle? Does that get you to 4%? Does that take you to 5%? I don't know, but trend is still up.
And that's why the 60-40 portfolio is still under assault. It's not out of the woods just quite yet. But we'll see. We'll watch. And it's not just domestic. It's not just here in the US that we're seeing bond pressure. Super amount of selling of international bonds, treasuries, especially in Japan. And we're seeing, credit spreads here with junk bonds and CCC credit instruments continue to move higher, which is indicative of lower liquidity. So yes, we're having a bounce in equities this week, but we're not seeing credit spreads cool off, which would be a characteristic of improved liquidity. So we're definitely not out of the woods on both of those scenarios, which leads us to a big narrative word the R word that we're hearing so much recently, which is recession. And the problem with that is we're already a little less than 20% off the highs using something like S&P 500. The market, it's fascinating that this word is showing up now when it wasn't showing up in January. It's because markets are future discounting mechanisms. I don't know when we're going to learn that price moves first and the
and then
narrative.
They come up with a story as to why it happened.
Right. Do you know how many times?
Sometimes the story is valid.
Sure, absolutely. Completely agree with that. But do you know how many times they revise GDP? All the time. They can revise GDP up to 2 years afterwards.
Oh my gosh. Are you serious?
Well, and I don't know the exact time frame, but it's revised frequently 1 year afterwards. You will look back one quarter and be like, we're actually revising that to this number. And so people give us crap all the time about, well, you're using price, which is looking backwards. Well, every other economic data point is looking backwards. And I would argue that price is a future discounting mechanism of the future, the present reality of what the opinions of are the next 6 to 12 months, not just a data point from the past 1 year that can get revised. So,
right. So if we were to rally here, let's say this is the bot,
right.
and we're back by, I don't know, let's say by November, December, we're back at 4,800 on the S&P, looking to break to all-time highs.
Right.
You think that they're gonna be talking about how great the economy is and things like that during that entire rally? I highly doubt it.
No, they'll be talking about the recession. We'll be breaking into new all-time highs, and people will be pissed.
People will be worried about who's, oh my gosh, who's going to win this
election
gubernatorial seat in Iowa.
And then
how is that going to affect the lobbyists of this industry?
Right. And they're going to be talking about, well, so we'll get a negative Q3 GDP print, but be going out to new all-time highs in the fourth quarter.
Yeah. Can you imagine that?
That drives people nuts. Do you know why? Because
just like COVID, right? How could stocks possibly go higher when you literally shut the world down?
Yeah, exactly. Price moves first. Price knows more than you, knows more than me, knows more than anybody listening, knows the collective opinion of the market. It's a fascinating thing. It's reflected in price. So your involvement in an instrument or non-involvement is an opinion. And that all
I've met him. He's the only one that knows. And he knows that he's the only one that knows. He's kind of cocky about it. But
yeah, a little bit.
And so, he's a good dude. But yeah, he does kind of mock everyone else, tell them they don't matter. And he's got a point.
Well, and it'll be this time next year, and the government will come out and say, hey, we actually have to revise the number from 2Q 2022. We actually had a negative GDP print. Well, what did you think the market was pricing in then?
Mm-hmm.
So it is nonstop that we get married to the talking heads on TV, the opinion pieces. You talked about Seeking Alpha, nothing against Seeking Alpha. It's a platform. It's great.
Well, the market bottomed by the time, like March 23rd, people still didn't know what was going on, like what COVID was.
Correct.
End of March is when they actually started, really truly
2020.
shutting these. Yeah, 2020.
Yep.
That's when they started shutting things down. You spent all summer trying to figure out how you're going to eat at a restaurant, and meanwhile, stocks are
ripping
to new highs. It's a non-zero chance, as David would like to say. It's a non-zero chance that somehow that same scenario plays out.
Yeah, we're not saying this is a bottom. No. But to be arrogant enough to think that somehow we know more than the market, I don't want to play that game. And that's because that's how you get your butt handed to you is thinking that you know it all when we know nothing. The only thing that knows anything is price, which is a future discounting mechanism. And so to Ian's point, yes, if we're breaking above 4,800, how aggressive are we going to be? But until we even mathematically reclaim 4,180, it doesn't matter.
Yeah, right? You can't get to 4,800 until, you got a lot of things. Like you said, 41 or 4,800, you got to get through 4,100 first.
Right.
You got to get through 4,300.
Shoot, we got to clean 3,900 first.
Yeah, we're not even below. We're not even above the May lows. So closing lows.
Right. No, exactly.
Some intraday lows.
And so
we filled this gap from last Monday. We just filled a gap from, it's been a heck of a run, but yeah, now you've got back a 6% plummet.
Yeah. And it's
still down 20% on the year.
Correct. And we're still lower highs, lower lows, downward sloping 200-day, 50-day, even, we're the downtrend is here. And this is why
the momentum comes. You can, right. And the moving averages only get worse because you start kicking off those good days that were all higher.
And relief rallies feel good.
They do.
That's why they're called relief. right? When I'm done at the end of a bench set, I'm doing some bench press and I'm done. I have some relief. It feels good. When the market is correcting and it's done correcting briefly, because I have got another set coming. So it's likely we have another set of downside coming. It feels good right now. Until we clear that 4180, 4200, it's likely that the downside continues. And we haven't really seen the capitulation yet. Yes, we see like just tremendous weak breath, and we can talk about the extended portion because we've kind of bumped up against the client portion here. And the breath continues to be weak. And does that continue? Well, it's a trend. I'd like to, Ian and I love upside markets as much as anybody else. But this is the reality of the situation, is that we continue to see weakness. And it doesn't matter what equity you're talking about, whether it's domestic, international, you look out on the risk spectrum, and maybe we could talk about that a little bit in the extended portion. Ian, is just like things like frontier markets, small caps, micro caps, things like that. And so maybe I'll leave that teaser there, Ian. Anything you want to touch base on before we go to the extended portion for our clients before we wrap up?
No, I think there's a big possibility, like you said, that, short to intermediate term, we go sideways. Maybe we go sideways. A lot of these gaps don't get filled. They are breakaway, are they breakaway gaps? And let some of these moving averages come, catch up as we work sideways for, I hate to say it, I don't know, a month or two. That would be a nightmare.
Bear
markets are nightmares. So
you could grind higher all the way through August and
look where this area. So you look at 3,600 to 3,900 on the way, or 3,900 on the way up. Not the prettiest trend.
No.
That was pretty sloppy there. That was early January 2021. Well, of course, now looking back on it, that's when most stocks peaked.
Mm-hmm.
But a pretty sloppy, so do we pause and see more sloppy action here on the way back down the mountain?
Absolutely.
It wouldn't be inconceivable.
There are no rules here that say that we can't grind higher in a counter trend move until mid-August, up into 4,000, 4,100, and then move lower. And it would be slow, and it would be grinding, and it make people feel good, right? Stocks continue to move higher. We'll see.
I feel like there's been enough rules broken so far over the last, for sure in 2022, definitely 2021.
Well, that's what markets do.
And I'm not saying rules. I haven't been. I've seen a lot of personal rules, just, or beliefs I had, things that were pretty consistent that just got thrown out the door. So I think that even more weird things can happen is a little short-sighted, I think.
Yeah, right. Exactly. So in summary, we continue to see lower highs and lower lows in domestic equities, in foreign equities, in risk on areas, even in risk off areas. We didn't even talk about crypto. We can talk about the extended portion. Bonds aren't out of the woods yet. We've now seen energy join the downside party. What was the number, Ian? Isn't energy down 20-some percent?
It's in a bear market. That's right. That's what it says.
Yeah,
that's what people. It's down like 22%.
So if you didn't have a risk,
definitely not an uptrend,
right? And people are familiar that we participated in that, but we also had a risk management process and haven't been participating in it. And here you've had energy wipe out tremendous amount of alpha and gains in a matter of a week and a half, something like that.
When you have that, right? And I remember, I think now you did a good job holding on to a little bit longer. I actually got out of XLE, I think at 80. It ran to 90, maybe even a little bit higher than that. So, then you start to think, oh gosh, did I cut it too early? But now what? We're sitting at like 70.
Yeah, you gotta have risk management protocols in place below a certain level.
And it did go, and then it came back down. Sometimes it just keeps going. But
well, I don't know if this is a pullback within an uptrend or if it's a false breakout.
Absolutely.
Right? We could see energy.
You can't have a bear market in an uptrend, Dave.
Correct.
This is actually XLE also had another pullback of 20% in summer 2021.
Yep. So glad you said that
Peaked
because
mid-June.
Yep.
Peaked,
so
energy
classic.
peaked June 12th, 2021.
It's almost like you're talking about energy seasonality.
Bottomed in August. So again, I'm not saying that happens again here. This has been a lot quicker decline. Could also argue there's been a loss, rate of trend has been broken. You could say it's still intact. Draw your lines wherever you want to fit your bias. I mean, we'll see. But
in a nutshell, we continue to see the move this week is counter trend in nature. Does it turn into something more? Open to it. Something like S&P 500 has got to be above 4180 for that to be a thing. Crypto continues to be in a downtrend. Bonds continue to be in a downtrend, and now commodities have joined the party, as we've highlighted this week with industrial metals, agriculture, softs. Things like cotton just getting dumped.
Probably the only things that are getting up with red weekly candles will be commodities and energy.
Yeah, and now those used to be the themes, and you have to have a risk management process for that. Happy to participate in when they're on the way up, and that could happen again. But with that, in the extended portion, we'll talk about some potential intraday island reversals, some breakdowns we've seen this week, as well as false breakdowns. And then we'll talk a little bit more about biotech. But you guys, I hope you stay on. If not, thank you for listening. And I hope you enjoy a beautiful weekend.
Have a great weekend, everyone.
All right, Ian, jumping into the extended portion of the podcast where we like to kind of dig into the weeds a little bit more. Anything you want to start out with before I take us towards maybe some breakdowns we've seen, some false breakdowns? We kind of touched base on biotech a little bit. But anything you want to go for from a technical perspective? I know you shared something with me shortly before we started recording. Just did kind of a breadth measurement, what stocks have been doing from a certain period. I don't want to lead too much there, but anything you want to touch base on before we go on to any of these other things?
We can talk about that. So it's just a quick study I was doing. I mean, just purely out of curiosity, number of stocks that were above their Iran September 20th, 2021 close. You could argue maybe August 8th, 19th-ish.
So you're saying what have stocks done, or what percent?
How many stocks are above their basically summer 2021 lows? And there was a lot of, these are areas, right, where I'm using things, right? The idea behind this, if you look at what the average stock did, if you look at the New York Stock Exchange Composite, if you look at Value Line Geometric, if you look at Russell 2000 or micro caps, right? Where in those ranges, you can pull all these charts up. You can see all the behavioral touches at both sides of these ranges. So if we take kind of the low point, was one of those low points, again, probably maybe August 18th is when it really starts to break down. But anyways, point of that being, how many percentage of stocks are above those highs, showing, okay, how many stocks are in a stage 4 downtrend? That's really what the concept of this is. How many stocks are in a downtrend?
Got you.
And so, that number sits around basically 80%. You got 80% of stocks that have rolled over.
That are below their September or their summer 2020.
There's summer 2021 lows, if you want to call it that.
And that makes so much sense, right? Because we've seen how many metrics of breadth that show that deterioration started in February, March of 2021. And the chart you showed me is it just accelerated in the summer of 2021.
Yes, it did. And the indices, these indices finally broke down, this year. But just again, another glimpse of under the surface. This has been going on for a year. That we've actually been down. Now we know indices have been sideways and went sideways, but so many stocks actually entering downtrends. It really began last August.
Yeah, August, summer is when it accelerated. If you wanted to mark like a peak It's February, March of last year. So we're well a year or more into a bear market. And so it is interesting because have we seen capitulation yet? What do you think?
No, I mean, not according to fund flows. And that's one right. And there's lots of things to go into fund flows.
Yeah. What do you mean by fund flows? Just like money in and out of different like funds overall?
ETFs, like, mutual funds.
Yeah.
It's a barometer some people like to use, but I mean, that includes like dollar cost averaging, following like automatic, I wouldn't say it's the best look. Say we wouldn't see, again, not to bring up Willie, but he shared some good stuff. I mean, sentiment's horrible, but when you look at actual positioning.
Right. Okay. Actually, no, Ian,
I haven't like really panic sold.
Yeah. I want you to talk about this because you did share a tweet. I hope I put a heart on it. I don't know, but this difference between sentiment survey and positioning from a recency bias standpoint, can you touch on this?
Well, I mean, everyone likes it. AAII has always been a big survey that people have talked about. And when you get to these extremes and people are, really bullish or really bearish or bullish, it's when you can tend to see reversals. People get overly bearish, assets go up. People get overly bullish, assets go down. So this, I mean, and we're at like really low levels, right? Everyone's super bearish, supposedly. But when you look at how these people are supposedly also positioned in their portfolios, it doesn't seem like they're that bearish.
Why is that?
So I have a theory that, so we're already down 20%, right?
I put a heart on it. I just did it. I just put a heart on it.
We're already down 22% from the highs. And what has happened like the last 2 or 3 times we've been down? You can do early 2018, late 2018. Yeah, March 2020, we did go down, I guess, like 35%. Intraday high to intraday low. Yeah.
V bottoms, baby.
But so I think that everyone's like, yeah, this market sucks. This economy sucks. But I know that we're going to get a V bottom or some type of bounce in here. So I'm not going to panic sell yet because that tripped me up a few times over the last 4 years. And
right,
I'm just not gonna fall for it on the 5th time. And
if they panic,
everyone knows the market sucks. Everyone watches it go down, but a lot of people won't react because they convince themselves that they're going to react late.
We're right. They can be bearish, but not sell their positions because, to your point, in 2018 and 2020, if they sold late, they got screwed because of the V bottoms. Like these things rallied quickly, and so they're not going to do that again. They're going to hold.
So I think there's a lot of psychological, like people feel stuck.
Yeah, for sure. And wouldn't a grinding market do that?
Yeah,
a grinding lowered market would absolutely do that. That would be a characteristic where,
because then it slowly turns into the like, well, okay, I'll get out, but I'll at least get out on the next decent bounce. Well, we haven't had a decent bounce in 4 months.
Well, and yeah, correct. Is the decent bounce, yes. And then is the decent bounce of V bottom?
Yeah.
Which I don't want to sell that because if this is another V bottom, then I'd be needed to sell, especially if you overlap a prior low. So it is a fantastic study in human behavior. I love that thought process, Ian, as far as what previous corrections have done to individuals. And I know there's a certain demographic that's super sensitive about the 2008-09 correction and whether they've ever been through a correction and whether they can handle another correction. But there's also a contingent that just went through, what have we had, 20+% corrections in less than 3 years, which typically we see one.
Depending on what index you use. I don't know. What did the Russell do in early 2020 or 2018? Did it fall 20%? No, 12.
But I mean, you use something like S&P 500. You had corrections that were 20% in 2018, 35% in 2020. 20% in 2015, 2016.
Yeah, I was gonna say, then you had your 2-year sideways range.
So we've had plenty of corrections, 20+% in 6 years. I mean, we're in the fourth one, 4 and 6. So there's definitely.
So I mean, what you're gonna call like, I don't think anyone wants to call, or they are. I would say maybe they are calling the market's bluff. They're saying, I don't think you're gonna go any further.
Yeah, it could be. It very well could be. We could have just marked the bottom with the last podcast, and here we are. We're ripping higher, and like what you were saying before, we're above 4,800 in the months to come. Could be, but at the same time, we continue to see lower highs and lower lows, and we haven't seen a grinding lower bear market, a protracted bear market since 2008, 2009, and even
I would say that wasn't as bad as.
Correct.
Oh, I mean, that was people like lives and industries and jobs and professions being ruined.
Right.
Worse economically for the country than the dot-com bubble.
Well, and it was interesting because you in 0809, the market grinded lower from October 07 into September 08. And you already had the Lehman Brothers announcement at that point. Yet you capitulated massively late 08 into 09 with counter trend moves upwards of 20%. Whereas a period like the dot-com bust, 2000 to 2003, that's a 3-year period of grinding down. Still had massive counter trend moves as well, by the way. And that goes back, I think we touched on this maybe 2 weeks ago. It might have been less. But, something like small caps, using something like IWM off the lows, even if we rally 27%, we're only at 209 and bumping up against a major behavioral level at 209 in IWM. That's 27%. That could happen. That's the least likely scenario, but it could happen. And counter trend rallies happen all the time.
They do.
From a breakdown perspective, I think of, we talk about copper this week. Dr. Copper breaking an important $4 level.
Stocks.
Wait, say that again?
Else? You got anything in stocks that's breaking down?
Related to that would be materials in my mind.
Crush, especially on a relative basis. Gold hasn't done anything.
Yeah.
The Bitcoin and gold, your two, the new school inflation hedge and the old school inflation hedge. And they love to throw mud at each other about who's going to be right when inflation hits. And when you believe it, Dave, both sets of dorks were wrong. Neither of them worked.
I can't believe it.
We have generational inflation, but neither of them done anything. Golly, Bitcoin's just plummeted, actually. There's been incredible hot takes out there about that. But
no, crypto was supposed to be all sorts of things, lots of promises made. And that's the hard part about human behaviors. There's always promises broken. And there will be something that comes out of crypto. There'll be something that comes out of blockchain. And I don't know that story is over. We could see new highs in those areas.
For sure.
We've seen breakdowns in Bitcoin, breakdowns in Ethereum. There's plenty of other crypto that are 70 to 90% down.
Ethereum's still below $1,000 now, 1,200 now, but still below those blow off highs from whatever that was, 2018. Still below 1,400.
Right.
Which I would say is the level that it needs to get back above.
For sure. And, when we think about breakdowns, we've got things like breakout or bout, which tracks breakout stocks, pretty big breakdown. So the opposite of a breakout. And we've got materials and copper. And at the same time, we've got false breakdowns, potentially in healthcare, in regional banks, maybe semiconductors.
Maybe regionals. I'm not super. I could see both arguments.
Well, it has to confirm.
Yeah,
like
I would have to confirm.
we don't know yet. So using something like KRE to represent regional banks, this area of polarity, which is around the $59.60 level, you need to see this break above 62 to confirm a potential false breakdown. Now, we've also seen where ranges are created or diamonds are created. Diamonds being these consolidation patterns where the middle of the pattern has a extreme high and the other one has an extreme low, and then you compress from that point forward. We could see this in a multitude of names, regional banks being one of them, healthcare being another one, semiconductors being potentially another one. And these take us all the way into like 2024 if we do this.
Oh, God.
Where we have these massive diamond distribution patterns that take place in lots of different things that take us all the way into 23, 24. It's possible. Do we get to be surprised when we've had market returns that have been above average? And I'm not a real necessarily big market distribution return guy. But with that being said, above average market returns off the COVID lows, even since, I would argue, since the bottom in 2009, that we wouldn't move sideways like this. It's possible. It doesn't feel it doesn't feel good. It doesn't feel amazing, but you could have these different areas that have false breakdowns, but that doesn't mean it's immediately going on to new highs. It's just back into the range and stocks move sideways. It's possible.
Yeah, I mean, look, okay, so you go look at the S&P in the 70s. I'd say two pretty big tops.
Wait, there was a market in the 70s?
There was.
So, okay.
S&P. So, I mean, we had a topping pattern basically from 72 through, so 2-year topping pattern. This is the S&P too.
Okay.
And there are some different dynamics on how the S&P was constructed back then versus what it looks like now. The S&P was a very, very different index. Yes, it was a 500 stocks, but not built nearly the same as the modern day index that we all know and have come to love. So you had a 2-year topping pattern, and then another from basically 76 through 77. So two-year ranges in the S&P within a 6-year span, 8-year span.
Yeah. I mean, why can't that be our market?
And you had a 50% drawdown in there.
Mm-hmm. And this is why you use risk management protocols. This is why you have processes in place to deal with different market environments. Because as I like to tell our prospects and clients all the time, maybe if we're blessed or fortunate, we get to pick where we live when we retire. You don't get to pick your market. I don't know what the next 3 to 10 years bring, but I do know we can use adaptive risk management process to navigate those markets. And so that's all we can continue to do. S&P 500 as an example, and I know we harped on that enough, but below 4180, we're at risk. Like, why do we need to take on risk?
I agree.
You did a great write-up that we called Falling Knives not too long ago for our clients. There are plenty of things that continue to move lower, even this week where we've seen a bounce higher, that have not fixed themselves. So we don't need to catch those just yet. How about we just let them hit the floor, then pick them up? I know it's an overused cliche and metaphor. I get it, but it's applicable.
It is.
All right, Ian, we should probably go do our day jobs. Is there anything else you want to touch base on before we close it down?
No. Again, do we see a continued bounce from here? Probably a better shot than we had last month. Very well could last longer, but again, you've got the momentum is now just only going to get worse when you think in the things in regards of moving averages and what rolling over behavior looks like. And it's fun. It's fun to sit and watch biotech be up. I don't know how much it's up this week, probably like 15%. And get all giddy. And it's had a great move. It's up 14. So it's close. IBB at least.
Right. But okay, and you said it before, like biotech,
but we also rallied 13% in May.
Right.
And we're back to that same spot. So
and it has huge beta, and there's a difference between talking about Biogen and some, like you said, like
exactly.
stage 2 trial biotech name. And when we track new highs versus new lows, biotech can skew the data. Is that a fair way to say it? Like there's times where biotech shows up.
Think about where the Russell would be if right, so it's the biggest piece of the Russell. Think where the Russell would be right now if biotech wasn't doing what it's doing, because energy's selling off and banks have barely bounced. So it's basically these like $2 billion. There's hundreds of them that are holding. I wouldn't even say though. At least this week they held the Russell together. Yeah, no,
it's fair. Biotech's a unique area, and to see a bunch of new highs out of there doesn't necessarily mean the market's turning around, especially when we see some barometers, some canaries not doing so well, like semiconductors and transports overall. And on the flip side, you've got FedEx doing okay.
Industrial's horrible. Small cap industrials did not even try and bounce until today. It's a decent one, and you're filling that gap from Monday. But
yeah, like you pointed out this week, breakdowns in Deere and Caterpillar. That's legit. Like breaking down your industrials or your infrastructure trades, or like infrastructure stuff like PAVE and infra. You've got some major breakdown, and so it's not an all clear. This week is not an all clear for sure. It is definitely the Willy Wonka elevator, sideways, slantways, longways, and backways. It doesn't there are many information points. It's not an all clear signal for higher. Now, of course, the market never provides an all clear.
Yeah. Dave and I don't have some checklist of 50 things, and as soon as the 50th box gets checked, we say, all right, we can start buying stocks now.
Exactly. You just take away the weight of evidence and you wait for the next data point to come in, which is next week. And once we're heading into like holiday weeks coming up here, with 4th of July around the corner. We talked about seasonality already. So we could see markets move higher from here. Right now, evidence-wise, they're counter trend in nature until we can clear 4180 in something like the S&P 500. So with that, Ian, we bumped up against the end of our time. I know that I appreciate all your work, how hard you grind for our clients. Much appreciated, the whole adaptive team. When we talk about our core values, core value number 4 being fostering a culture of learning and performance and exceeding expectations. You guys have done that. And so I'm proud of you guys. Anything else you want to touch base on before we get out of here?
Nope.
All right. Awesome job. Appreciate everyone listening. Touch base in a few.
Have a great weekend, everyone.